welcome to our interview with Sean O'Hara, president of Pacer ETF Distributors. Pacer ETFs recently won the With Intelligence Mutual Fund and ETF Awards ETF Suite of the Year for its Pacer Cash Cows ETF series. So congratulations. Sean, it's a pleasure to have you here.
It's great to be with you as well, and thank you so much for giving us the award.
Well deserved. Tell us a little bit about your business.
So Pacer ETFs is an ETF issuer just outside of Philadelphia, Pennsylvania. We just recently crossed the 25 billion in AUM mark. We're a little bit different than some of the bigger players, if you will, in this marketplace. We don't really tend to do sort of cheap beta replication. We tend to focus on three keywords like innovative, disruptive, or unique. So we like to build ETFs that are different in some way, that solve a problem or that have maybe a need in the marketplace. And so that's where the whole cash cows idea came from, was a different way to think about value. And we're also sort of different in the sense that we have a fairly large distribution effort on a relative basis. We have about 79 external wholesalers and 4 divisional managers and 40 people here in the inside that work as inside salespeople. So we focus all of our attention on financial advisors, and we spend a lot of time out in the field talking to them about the ETF solutions that we build here and how they fit in client portfolios.
Great. What exciting developments did Pacer ETFs have last year that led you to win the award?
Well, I think the biggest thing was just sort of taking a different look at what traditional value was. Investors forever have been using sort of growth and value tilts, going back to some academic work that was done in the 90s by a couple of gentlemen by the name of Famet and French, where they, discovered that if you focused on low price to book stocks over time, you might have actually exceedingly better returns than the broad-based market. That same approach, unfortunately, hadn't worked for the last 3 decades. And we think that the reason for that was that the stock market's value today is primarily based on intangible assets, not tangible assets. So there's no real physical book value left, if you will. There's not much. And so traditional value sort of winds up in the same sectors like utilities and financials. We use free cash flow and free cash flow yield as a better way to identify stocks that are cheap on a relative basis than their peers. So it's a simple valuation metric. You take the free cash flow a company generates on an annual basis and divide it by its enterprise value, which is their market cap plus debt. And it just tells you essentially what you're paying to get a dollar's worth of free cash flow. So we have had this series for quite some time. It sort of has, in this latest cycle, and shift back from growth to value for a bit, sort of, caught a tailwind, if you will. And so the last couple of years have been really terrific for the strategies. And we've built beyond just COWZ, which is the largest. We've built CAF, which is small cap, and ICOW, which is international, and GCOW, which is global. And then what we're hoping to do now, we launched in December a large cap version, and we just launched a small cap version. We're hoping to do the same thing with growth that we did with value. We think the traditional metric, which is heavily weighted on sales growth, has a potential flaw, and there might be a better way to do that. So the jury, I guess, was still out on whether we're going to be right on that one, but we certainly were right in terms of free cash flow and free cash flow yield versus traditional value, because most of the strategies have delivered excess returns versus their benchmark since they've been launched.
That's for sure. Great. Tell me a little bit about what opportunities you see for the year ahead.
It's an interesting year so far. It's one of those years, it happens every once in a while, where a very small number of stocks, if you will, dominate the broad market index returns. It's kind of interesting. Tomorrow, NASDAQ is rebalancing sort of on a special rebalance because 5 names became such a big part of the index that in order for them to keep them there, if anybody had a fund or an ETF that was tracking the NASDAQ, they would violate what's called the RIC rule. So, we've had sort of a strange year, but not an uncommon year. The thing people need to keep in mind about that is, though, that even though things like this happen from time to time, they never last. And so if you feel like, that what's happened here recently is not unique, but for sure, which history would tell you it never lasts, then you have to think about how you're going to position portfolios going forward. So either one of 2 things will happen. Either those big market cap names will come back down to earth a little bit, or the rest of the market will wind up elevating itself. And so I think maybe one of the biggest advantages investors could take advantage of in the next part of this year is to move slightly away from market cap weighting, because if those big names come down, obviously that would be bad for market cap weighting. And if those smaller names come up to meet the big names, then you would essentially not have enough weight in those names. So finding a different weighting scheme, we use free cash flow and dollars to weight the cow series. And that might be a better way to play the rest of this year and see what happens. And secondarily, I think there's this trend. We'll see. We're entering earnings season right now. We'll see what happens with earnings. Earnings have been slowing, and so I'm not sure that in a slowing earnings environment you want to pay up for stocks. And the market is still generally a little bit expensive on a historical basis when you measure PE. So having a little bit more conservative approach, moving away from market cap weighting to some other weighting scheme, might actually be a better way to go going forward.
Always a challenge, but that's what keeps it exciting, right?
It is. It's a great
Excellent.
business.
Sean, it's been such a pleasure having you here today. Thank you so much.